Well, welcome. We're back at the Metropolitan Club again, and I'm John Henry, Chairman of the Committee for the Republic. Henry Adams was half right in defining politics as a systematic organization of hatreds. What he neglected to say was that politics is also the systematic weaponizing of government by the rich and powerful to protect them from the gales of competition at the expense of everyone else, of us. Regulatory capture is inescapable. The regulated spend extravagantly on political campaigns and lobbying to control regulation. The upside is limitless. CEO Jamie Dimon rejoiced over Dodd-Frank building JP Morgan a bigger moat. And if you're a Buffett fan, a bigger moat is what people want to avoid competition. In the blink of an eye, the Export-Import Bank became the Bank of Boeing. James Madison saw government as necessary because men are not angels. But he equally recognized that the cure would be worse than the disease, absent a separation of powers that pitted ambition against ambition. Regulation defies that warning by combining legislative, executive, and judicial functions, powers in single agencies. Yet, every economic interest seeks to enlist government for its self-enhancement. Our speaker this evening, Dr. Nomi Prins, and we welcome her back for the second time. So I guess about 5 years ago. She will masterly expose the dynamics of this regulatory capture phenomena in the financial sector. Nomi is fearless. She's a cultural hero of mine, a whistleblower on the too big to fail banks, the rare insider like Dan Ellsberg, who is willing to say the emperor has no clothes. Is the Fed, Nomi, too big to fail? Is it a cartel of too big to fail banks with the government's name on the door? Nomi, please come and tell us everything we need to know about the Federal Reserve.
Thank you. I'd like to thank all of you for, particularly John, but all of you for being here tonight and for inviting me back here after the last time. For those of you who were here, we had a very, very lively conversation about too big to fail and bailouts and where the banking system had gotten itself to. This was all pre-pandemic and pre some extra help it got in 2019, which I will get to. But to answer your question first, because this is also a conversation, is the Fed part of that triangle? Is it connected too closely to Congress? Well, we have an executive, a legislative, and a judicial side of Washington here. I think the Fed is a fourth part of that. And I think they have their own little bucket. And I think that they act particularly together with the financial industry, but they have also superseded the powers that they had received under the Federal Reserve Act of 1913 by just a really big amount, particularly since the pandemic of 2020, but starting with the financial crisis in 2008. So working all of that together into what we believe is the sort of better way of government, or at least inviting the markets to be transparent, competition to be a part of our economy, and our economy to be stable. Well, the Federal Reserve has acted in ways that go against all of those principles. Now, my new book, and I was here talking last time about a book called Collusion. It was not about Russia. It was about how central banks rigged the world. And I had gone about the world where I had spent a lot of time throughout the world as an investment banker for Goldman Sachs, Bear Stearns, Lehman Brothers. Those two don't exist. So I know what it takes to kill yourself from the inside. As well as Chase Manhattan Bank, speaking of Jamie Dimon, where I had started my Wall Street career after getting a mathematics degree in my undergraduate State University of New York at SUNY. So I called this book Permanent Distortion because it's permanent. So I want to talk a little bit about that distortion and how what has become normal in the financial markets is different from what normal ever used to be and how we're never going to go back. I want to start with a quote from Charles Ponzi in 1920, because that's actually how I start the book. Well, to be honest, I start the book with a quote from the Red Queen in Alice in Wonderland, which is, it takes all the running you can do to keep in the same place. If you want to get somewhere else, you must run at least twice as fast. But what Ponzi said was that we all crave easy money, because if we did not, no get rich scheme would work. Now, he knew of when he spoke, and he wrote these words when he was in jail. But before that all happened, Ponzi lived in an era. Just to take you back a second in history, I know we're all historians here as well, where we had just gone through World War I, a flu, the Spanish epidemic, and also our country was facing a recession, as was much of the rest of the world, which was unexpected considering we had attempted to stay somewhat out of World War I until the end, etc. He was in Boston, Italian immigrant, hard worker, and he came up with this scheme, right? And his scheme was this: I'm going to buy a bunch of US stamps at cheaper prices than I can buy them here internationally. I'm going to sell them to investors. I'm going to promise these investors that in 90 days, they are going to double their money. And I'm just going to keep that going. And I'm going to buy them cheap. I'm going to sell them back to the US government at full price. That was the legal part. And I'm just going to keep promising them and promising him and promising. The problem was there was no way he could keep the promise of paying Peter from Paul, going and going and going, unless he had more Peters to pay the Pauls. And when the Peters stopped coming to pay the Pauls, there was just not enough money to pay the Pauls. It didn't matter how great the scheme looked, how much he marketed it, how much he talked about how he'd grown up from this, sort of poor place and made himself actually a champion fighter against the big banks. This did not work. And he was arrested and he was thrown in jail. And he wrote his autobiography from jail, which I recommend you all read because it's actually fascinating. And one of the tenets of this particular autobiography of Charles Ponzi was this idea that if you could make people believe in your money scheme, you had them. Now, I liken the Federal Reserve to a Ponzi scheme. So I want to put that right out there, particularly since the financial crisis and on steroids. In the book, I call it overdrive since the pandemic. And here's why. When the Federal Reserve was first created in 1913, even at that time, it was based on a blueprint. And I talk about this more in my book, All the President's Bankers. It was a blueprint from a meeting that had occurred at Jekyll Island. I'm not going to go into all the details of that. It's in my book, All the President's Bankers. But the point being that the original blueprint for the Federal Reserve was a meeting outcome of the head of the Senate Finance Committee, Nelson Aldrich, who was also the uncle of ultimately one of the heads of Chase during the crash in 1929. Again, different book, but it's important to realize there's a connection here. And a bunch of lieutenants, or I should say senior executives from banks representing what are now Citigroup and also Chase, represented through JP Morgan, which is part of JP Morgan Chase now. He was not at this meeting. But the idea was that we're going to create a central bank. It's going to be able to fund banks when banks can't find funding for themselves because of crises, because of wars, because of panics, because of just people making runs on these banks, because they're economically anxious or whatever. It took 3 years for that blueprint, that conversation on Thanksgiving 1910 to become the Federal Reserve Act in 1913, 2 days before Christmas Eve in Congress under Woodrow Wilson. The conversations internally with Woodrow Wilson, again, I go through this in detail from the actual transcripts of their conversations. They weren't transcripts, they were notes that they wrote, letters that they wrote to each other, had to do with the fact that Tom Lamont, who was executive at the Morgan Bank, representing the Morgan Bank, was trying to suggest to Woodrow Wilson that the way to sell Federal Reserve to the country was to say that the farmers in the middle of the country and the new business leaders in the West Coast of the country had a right to money that was being concentrated on Wall Street in the New York banks. And if you could basically tell the American people that everything that was concentrated when there was any kind of a crisis would have some system that would make sure it got to the rest of the country when things were really bad, that would come back out of that sort of concentrative deposit cartel, it would be okay, this would pass. They did pass the act. That was the idea of the Federal Reserve. 12 reserve banks across the country. They all represented the banks in their country. They represented the businesses or the communities or the parts of those areas that drove the economics of that country. I've spent this last year visiting many of these banks in St. Louis and Kansas City and Chicago, in Atlanta, basically throughout the country, because every piece of the central bank system in our country had a role. Now, why is it a Ponzi scheme at its center right now? Not because of the idea, but because of what it became, particularly in the wake of the financial crisis of 2008. At that time, as we've discussed, I've discussed here, and as we know, there was a financial crisis. It was caused by Wall Street. It was not caused by people borrowing too much and lying on their applications or being misled on those applications. That was a piece. That did not drive the financial crisis. What the financial crisis did was take all those little pieces and engineer them into larger assets that basically were sold throughout the world, borrowed against. It was a Ponzi scheme. It literally was. There was not enough money coming in from these subprime loans at the bottom of all of these assets to pay up through all of those assets if literally anything went wrong, which it did. We had a subprime foreclosure crisis. We had defaults. But as a result, everything came crumbling down. Hank Paulson goes to Nancy Pelosi. He says, you know, if we don't get money from Congress, the world's going to be worse than it is right now. People aren't going to get money out of their ATMs. Now we use our iPhones, but whatever, ATMs can get money out of them. And it's going to be a problem. So we do get a package and we do bail out those banks, $700 billion from Congress. But that was also when the Fed went into its first part of what is now a permanent distortion. It basically said, all right, well, there's a 700 billion divided up through the banks. They get made whole. We sort of eke ourselves out of this. The economy, you know, will be what it is. And we're going to create $4.5 trillion, not 700 billion, $4.5 trillion of fabricated money to buy debt from the system, to inject into the banks, and to effectively create a habit, which I talk about in the book later becomes an addiction, of those banks, of the markets, to that money that's now been jolted into the system to be there, $4.5 trillion. Now, I could spend a lot of time more on the financial crisis, but that would take us much more of the night. So fast forward up through 2019. I'm going to just like fast forward, during which time, just imagine in a blur, we've got a credit crisis in Europe. We've got Russia taking over Crimea for the first part in 2014. We have 2019, which was the #1 year of political instability and social unrest across developed and developed countries in our history in terms of the disbursement. And we have a lot of other things going on in our economy. The US economy is sort of doing this. It's kind of like a flat line, up to, down to, it's kind of staying flat. Meanwhile, though, the stock market's going up quite substantially, except when the Fed decided in the end of 2015 to raise rates by a little bit. Stock market freaked out, Fed waited a year, raised rates again a little bit in 2016, and started continuing to raise rates very, very slowly, not like now. until Wall Street said, wait a minute, we have this problem. End of 2019, our banks that we actually deal with, our entire system is having problems trusting each other overnight. We do not trust the system we have built, which is a system by which big banks, they still do this every single day. We lend money to other big banks overnight to help them like deal with their books. We basically lend money to corporations to help them deal with their books. And then the idea is everybody's confident enough that it's all going to get paid back in the wash the next day. Well, this was starting to crumble. And so the Fed said, well, you know what? Here's some money. Let's just kind of help you out. Let's get involved in that market, even though the Fed is not supposed to get involved in the day-to-day credit situations between banks and banks and banks and companies, but it did. And it started to create some more money. So what had been $4.5 trillion of money the Fed created, and this is one central bank around the world, it's happening everywhere. But what had been $4.5 trillion since the financial crisis the Fed created, gone down a little bit to 3.7 in the middle of 2019, just attrition, bonds came off, nothing major, nothing was replaced, went down to 3.7, went right back up to 4.1, 4.2 before the pandemic because Wall Street banks were at it again and there was just problems trading amongst themselves and lending amongst themselves. Fed steps in. This doesn't get talked about a lot in the media, kind of it got revisited after the fact, but I wrote about it, but it wasn't written about a lot. Then the pandemic happens and all of a sudden we are in this like netherworld of economic shutdown, fiscal stimulus, because people weren't able to work, and the Fed helping the economy by injecting another $4.8 trillion of money, so more than what they had done in the years after the financial crisis, into the banking system, not into the economy. This was the big lie. It did not go into the economy. A little bit of fiscal stimulus went into the economy. A bunch of bonds were issued, so we did increase our debt, but that ratio was about 1 to 6. In terms of what actually got used for the real economy and even what got used for real debt that the government did borrow for the purposes of CARES and other types of programs, the rest of it went to finance. And as a result, the market was really, really happy, having gone like all crushy and all basically uncertain as to what would happen if companies really shut down forever. And we didn't know, right? We were all in the middle of what's going to happen. But the markets had the benefit of all of this extra money and all of this extra leverage and new borrowing that came on top of that extra money. And as a result, they went down from that low point in the March of 2020, in the beginning of the pandemic. And they zoomed far, far past that, past double. Not every company, but a lot of companies at a very rapid rate. I have a stat in the book, page 17, that basically says, even if we look at the top 10 billionaires in the country that were associated with the stock market, their rate of increase of wealth during the first 2 years after the pandemic, but predominantly in the beginning of that jolt period from the Fed, was increasing at a rate of $15,000 a second. $1.3 billion a day. During that period, their collective wealth, 10 of them, went from $700 billion, which is a lot, it's a lot, to $1.5 trillion. Why? Well, we know what was going on. A lot of money was going into their companies because there was a lot of money sloshing around. The money wasn't so much all going to rebuilding the economy and rehiring people. That would have kept things at a sort of relative even. What it was doing was being accumulated, being leveraged, and being invested very, very quickly into the markets. And it was not just the Fed doing this. This was happening throughout the world. The Fed just happened to be the leader. And it happened to have increased the size of its book, i.e. the fabrication of that money, more quickly and by more than any other central bank. But all central banks were doing this. Right now, the world is sitting on a cushion of about $41 trillion worth of manufactured money at the bequest of central banks. Now, this is on a comparative level, way, way more than any war, World War I, World War II combined, in terms of how much money outside of the system, not coming through production, not coming through wages, not coming through work, not coming through savings, not coming through strategic plans for building for the future, was just accumulating. So now we have a situation where markets have been uncertain. They've come down a bit. The economy, I think, well, because of the fact that GDP in the two past quarters was negative. This quarter, it's probably going to be a bit positive, but for the most part, we're back to a flatlining GDP situation. So our economy is not really growing again. Inflation is certainly high, but that's different. If inflation were, sort of coming at the same pace as economic growth, we wouldn't even really be talking about it. But also that inflation isn't necessarily just because of the Fed. But anyway, the Fed's caught in the situation where it's thinking, okay, well, maybe I really do have to act like I know what I'm doing. I say this on behalf of the Fed. So we're going to raise rates very, very aggressively over a very, very short period of time. And somehow that's going to help inflation. Now, inflation has only literally not moved since the Fed started doing that, and in some areas increased. So that's something that's happening. The only thing in which prices has even remotely come down a little bit during this process since March this year is a little bit in housing prices and the speed of home sales. However, to augment that, and in comparison to that, rents have gone up for real people throughout the real economy. And the cost of getting a mortgage for people coming into the ladder, being able to buy their first homes and so forth, has basically doubled from the standpoint of what the payments would be per month. So you're basically keeping a whole lot of people on. Other than that, food's gone up, fuel has predominantly gone up, and a lot of other things have also gone up. However, there is this process. But behind it, getting back to the Ponzi scheme, there is this other thing that's going on at the same time, which is that the Fed's book, which got to as high as just below $9 trillion during the first quarter and second quarter of 2020, is at 8.7 and change. Now, trillions are big numbers, but that's not a really big difference. So 8.9 and change, 8.7 and change, and throw a whole lot of zeros onto both sides of those digits. It's not actually a big difference. The Fed has said it's going to let bonds roll off because it is fighting inflation, but it can't, and it isn't. And what's rolling off of the Fed's book is very minuscule compared to what it has created, and is not just the Fed. This is happening throughout the world. And also what's happening with major central banks throughout the world is they stand ready to continue to create money when they deem there to be a crisis in their financial system that either their government can't handle, their banks have screwed up, their finance situation has become unstable because of. This was just happening in the UK. The Bank of England was one of the cadre of banks that basically created all of this money during the financial crisis and again during the pandemic period. But just a couple of weeks ago, there was another crisis that happened in the UK. It was in pension funds. And mind you, pension funds are kind of at risk here too. Separate possible topic, maybe Q&A, I don't know. But the pension funds in the UK are like a perfect example of how this is all a Ponzi scheme in operation. UK pensions need to pay off pensioners. That's why pensioners put money into the pensions over years. The idea is at the end of some time, they get that money back so they can live their retirement lives. Pension funds there invest in government bonds as they do here and other things. One of in terms of their government bonds, their gilts, what happened was the pension funds were like, well, we can't pay our pensioners off of the very low rated bonds that we have accumulated because of, they don't say it, but quantitative easing over the past 14 years, among other things. So we're going to borrow money and we're going to create derivatives and all sorts of fancy financial technological things to make what we have to pay out pensions, which are our UK gilt government bonds, last that much longer and cover that much more room. The problem is when the cost of borrowing those gilts to pay that return to pensioners increased when rates went up, all that sort of disappeared. And all of a sudden, the pension funds are not just facing the shortfall they were facing anyway, they're trying to figure out how to repay the money they borrowed, I'm simplifying, to borrow enough gilts to pay the pensioners that they had to pay. So Bank of England says, all right, guess what we're going to have to do? We're going to have to create money and we're going to have to buy some gilts. So even though we're on this process of fighting inflation and raising rates to do that, when push comes to shove, and this is just one recent example, I believe there'll be many more. Bank of England's like, we're just going to create 60 billion pounds worth of gilts, of sort of money to buy gilts so that we can avert a crisis. That's where our Federal Reserve and our central banking system is today. It's in a mode where even when it's trying to fight a crisis, it loosely determines itself to be able to control. and another crisis pops up, it can still, with no regulation, no legislation, no elections, and no representation, decide what it can do in terms of creating money, stabilizing the financial system, and as a result, pushing forward the instability of the financial system that exists at its heart, so that we don't have to pay attention to it, so we don't have to do anything about it. We don't have to wonder how come it is so permanently distorted from the real economy. And I think this is a thing that's going to happen again and again and again. Maybe not tomorrow in the US, but we have certainly many, many budget and financial problems. Budget from the standpoint of what happens here. Financial problems with respect to what's happening right now on Wall Street. We're seeing more loans default. I mean, this is why in the last go around with the financial groups, with Jamie Dimon and Chase and the other banks, they reported some really good earnings last week. But they also set aside more money in reserve to cover loan losses that they expect will be coming up. So there's a lot of murk going on, sort of again, after the financial crisis, after all of the issues with bailing out, after all the conversations we had in what was Dodd-Frank, which we talked about last time, and which John brought up, which was supposed to sort of actually tame the big banks, when in fact what it did was give them more power. This is all still the crux of the financial system. So when I talk about permanent distortion, what I absolutely mean is this is a permanent reality of what we are living in. And when I say permanent, I don't just mean living in right now. There is no normal. There is no situation whereby all the Federal Reserve, the Federal Reserve's book and all of the books of all the central banks around the world are going to go back to zero to a little bit, just to be there as the actual cushion they were there to supposed to have been. And where that cushion is going to be something that the financial system actually adheres to. That's not going to happen. We may be in rate raising mode right now. But if we step back and look at the totality of how just enormously powerful central banks have become. And in my last book, Collusion, I talked about it being the era of central banks before permanent distortion, where they had basically supplanted Wall Street because of their ability to create money from nowhere, which even Wall Street has a tough time doing. It can't just flip the same kind of switch the Fed or other central banks can do. That we've now gotten into this environment where the money that goes to the economy, the way in which we consider strategizing to build the economy and how people feel about their day-to-day economics is completely disconnected and distorted from the sort of money machine and the power that that gives at the top. And as a result, I think we're going to not necessarily go into mega crisis mode and fall off a cliff. What I think is we're going to be in this permanent wave of mini crisis money, and we're going to have to really work through a period of immense uncertainty as a result. And that's going to have knock-on effects with social unrest, political instability. Again, the UK, multiple prime ministers and not a lot of time. But this is something that's happening really throughout the world. And I think this is going to be our permanent situation because of permanent distortion. And so with that, I would like to thank you again for listening to what I just said. I am going to apologize for permanent distortion not being here. It is, I know, available at Politics and Prose because I'm going to be there on Thursday night, but Thursday night, 7 p.m. So if you want to do a repeat of this or just sort of like, just Zoom the place, it's up to you. But it's a great bookstore. Books are there and obviously available at any place you would buy books to read or to listen to. So thank you very much.
Behind the founders, we have a one-line presence for you. Here, I don't know if we can see them, Max. Can we? Okay. I see Ed Hughes and I see Todd. I see Ivan, yeah. And there's Alex Pollock. There you go. So Alex, you are in Chicago and you wrote this really interesting article about the Fed. Did you say that the Fed has is $1 trillion in the hole in terms of it's never run a loss since 2013 and now it's running a loss? Is that what I read?
That was 1913. They
Right.
haven't run a loss since. They have their unrealized loss on their investments are on their whole balance sheet. We estimate as of mid-October to be $1.3 trillion. That's an unrealized, that's the mark to market of the Fed's balance sheet, which contains inside it a position, a net position of about $5 trillion, very long-term fixed rate assets funded by short-term floating rate liabilities. Now, the whole balance sheet, as was said, is about 8.7 trillion, but the position long investing versus short floating rate funding is about $5 trillion. And when you mark all that to market, you get minus 1.3 trillion. And because the basic structure, as I like to say, is that of a 1980s savings and loan, when short rates rise, the Fed's profits fall dramatically, and it is now the case in October 2022 that they are also making operating losses because the cost of their funding has gone up so much and is much higher than the yield on the old fixed rate assets, that it looks like they've lost about $5 billion in the last month, which is an annualized loss rate of $60 billion. And either the 1.3 trillion mark to market or the 5 billion or the 5 billion a month, which is 60 billion a year, look big compared to the Fed's total capital, which I don't know if anyone knows what it is, but it's 42 billion. So there's a very interesting situation now. There's a great debate over, does that matter or not? But at least it's highly indicative of what the Fed's balance sheet has done, which is to bloat up extremely large, fill itself with mortgages, with mortgage securities, and long-term treasuries at very low rates, and now be financing them at rates which are much higher, which are historically normal rates, but much higher than they were. So that was the situation I was describing to you, John.
Yeah, I mean, it's kind of insane when you think of it, it's true, right? You're basically, by raising rates, and not necessarily, again, raising rates is not literally the culprit here. It's the speed and the veracity of this particular rate hiking situation, in lieu of the fact that it has such a large book of treasury and mortgage assets, and the mortgage assets are related to treasury. So basically everything comes down in value when rates go up. So I think it was in my last book, but I said that the Fed was the largest and this was before the pandemic, that the Fed was the largest hedge fund in the world. Now, hedge funds can go long, they can go short, but the idea of a hedge fund is that you're financing your positions at a lower cost than you can get on for a return on those positions, and that you're not actually trying to pay more for positions to lose you money. I mean, that's not. I mean, that happens all the time. Long-term capital, I mean, it happens all over the place. But the Fed is technically supposed to be there in a position of being both a lender of last resort and to create some sort of outside stability for the financial system. That was one of the reasons it came into existence here. And so it's ironic and insane that, yes, it is operating, and that's a really large number, that it is operating such a big loss by virtue of its own activity. Like it's a self-inflicted loss, and it has ramifications for U.S. government as well, right? The U.S. government effectively had its bonds purchased when they were at cheaper yields by the Fed. Those bonds are on the books of the Fed, and so now if the government wants to borrow more money, which it does sort of every second, I mean, it does, then basically the Fed at the moment isn't there to act as a buyer of that debt. So the cost of the U.S. basically financing itself has gone up, as well as the Fed's book staying the same size and losing money, which is one of the other reasons. I don't know. This is just, I bring this, I'm looking at a picture of our founders here, but oh, you have to, oh, I see. But it's interesting in that the more the Fed raises rates, the more their expenses rise on their balance sheet, the more losses they have. And the more losses, of course, the government has in terms of relating its payment of new interest rates on higher interest rate bonds than it has now and as it gets into every day. So it's a complete mess. And yet the Fed, as a sort of fourth unelected pillar of our government, is not in any way responsible or responsive to us. We can't unelect them. Yes, we elect people in Washington and they appoint and they affirm, but we don't have a direct tie into this particular body. If Powell was a hedge fund CEO, he might be looking at a hedge fund that was crashing or just getting fired. But I mean, it's not just him; it's the whole mechanism that's at fault here.
Could I just say, I agree with almost all of that, except for the metaphor. You call it a hedge fund. I call it a savings and loan. Vintage 1980.
But if they were private equity investments instead of treasuries, what would you call it?
If they were private equity, then I think you're right.
So it's just
But they're mortgages and
asset class.
treasuries. Yeah.
Yeah, no,
And the position, we recognize the position, very long assets, short liabilities, as you said.
Okay.
Thanks, John, for that chance to comment.
Yeah. So what are you two, are you agreeing? Is this $1 trillion, the Fed losing money for the first time since it was created? Is this the new normal? And what's this? Is this what in the Episcopal Church we would call an outward and visible sign of an inward weakness? What is this?
It's a permanent distortion. No, what it signifies is that when the Fed grew its balance sheet by as much as it did, as fast as it did, under, again, the narrative, it was helping the real economy, but not doing the actual math or showing the actual math. It basically was writing its own loss structure. With, again, not either thinking about it, thinking of an exit strategy, or articulating how what it was doing could ultimately result in this kind of a problem. It can't sell the treasuries, even though, and this is one of the reasons it can't sell the treasuries at the pace. It's not selling them, even let them roll off at the pace that it said it was going to roll off. And actually, if you look at their H4.1 reports, and I don't know if you've looked at that, Alex, but I'm sure you have. Who I'm talking to, of course you have. But they are here and there buying back little bits of bonds, even though they're in a rolling off period, which is how you get from 8.9 to 8.7 in 6 months, when you say you're basically going to let 45 billion to 60 billion roll off per month. If you do the math, you're not there. But part of that's because of this problem. So they're writing their own sort of reason for them having to ultimately adhere to some sort of sane transparency or financial activity, rather than just being sort of allowed to create as much as they can create without necessarily looking at the flip side until it becomes a big loss to themselves. Making it a bigger loss would hurt the broader markets and economy. And what they're doing is actually hurting the economy, both on the upside, the real economy relative to markets, and on the downside.
It's working. Oh, cool. Wonderful presentation, Nomi. Loved it. I think you made a terrific case that the distortion is enormous, that, we printed this incredible amount of money, and we've also borrowed, a fabulous amount. I guess two comments. One is that I don't think Paul Horn's here. Is he tonight? No. Paris. Okay. Oh, okay. Well, hi, Paul. We have an argument about the Fed's role in this whole disaster, and of course, Paul makes, I think, actually a good point in that he would say that, gee, it's not the Fed that's the problem, it's the Congress. And I would have to agree to some extent that if you borrow $3 trillion, where are we going to get the money? Right? In other words, we don't have the level of savings in this country. We're a big country, but we don't have the level of savings in any way to support our consumer borrowing and our commercial borrowing and a government that borrows 1.5 trillion or 3 trillion or whatever. I mean, that's a lot. And I think we have to print, okay, to keep the beast fed. And I think in that sense, the Fed's doing the right thing. Is if they didn't print, there is what we used to know, or longtime economists know, is the crowding out effect, right? So the government crowds everybody out and the rates soar. So I think the Fed's trying to keep the rates down from soaring, even if they're raising them a little now. But the bigger issue is distortions, absolutely. My question is it permanent? And because I have a hard time believing that the stock market or bond market is going to be able to handle these big ups and downs, and you're still going to get buyers. The market's a real market. It's got to encourage buyers. It doesn't need, sellers, who cares? But if it doesn't get buyers, it's going to go down. And if it doesn't perform well, I think it's going to go down. And I'm not sure how permanent the distortion can really be if ultimately all of this money printing does lead to monetary inflation, which we haven't seen too much. As you say, a lot today is supply and demand. But eventually, I think you get monetary inflation with continued printing needed to support the government and everything else. And I think that makes it less than permanent. So what I'm saying is make it real simple. Nomi, is it permanent? Are you sure it's permanent?
Well, no, but if it's not permanent, what is
Then I say, as we've talked before,
Yeah.
as we've talked before, that at some point you print money because you're forced to print enough money to keep the whole thing rolling, that you create monetary inflation of say 10, 15, 20%. And at that point, you freak out the bond and stock markets to the point that it collapses and it's not permanent.
So a market collapses. So he's saying,
Well, so you're saying that there would be a market collapse if there were not printing.
Correct.
So
if you continue to print, guaranteed to get a market collapse. Because
Right.
at some point, you're going to get that inflation.
So I think we agree on the first part. And I know we've talked about this a lot, but just for everyone here, I think it's fair to say that we agree on the fact that without printing, i.e. without creating money to buy debt securities out of the market from the financial community and have that go and create its own life, I'm just paraphrasing, into the markets, bonds and stocks and other financial assets, we would have a crash. I agree on that. That is why I think it's permanent, because just to finish that off, if the Fed were like, you know what, we're going to go not to zero, we'll go to 800 billion, we'll go to 1.3, but we'll go to the deficit. We'll go to the level of, let's just say what it takes right now to run the government, just as a number. Let's just say they're not literally able to do that because that would crash the market. And if every other central bank, we know if they decide we're going to sell $7 trillion worth of treasuries or more, 7.5 of treasuries and mortgage bonds collectively into the markets, just turn it all back and just literally plug the hole between what we take in terms of revenues into the Treasury Department, what we need to run the budget of the country, and just keep it more or less at that, little nigglets here and there of like movements. That will be something that's possible, right? But it's not, because selling all of those assets would crater the markets. And that's one of the reasons I actually think it's permanent. So what happens instead is you have to throw Wall Street back into the equation. It's not just the government, it's the markets, as when I say Wall Street, the financial system, not just New York, obviously, but the global financial system that requires an outside buyer to a lot of the assets that it is involved in. That includes being primary dealers for treasury bonds, includes being primary dealers for UK gilts, primary dealers for your European bonds and so forth. The Bank of Japan owns basically most of the Japanese bond market, all of that. If we actually sort of dial that back really quickly, I think we would have a major market crash. And that's one of the reasons I don't think that we're going to dial it back quickly. What I think is going to happen is we're going to keep it, i.e. the central banks are going to keep things at this kind of a level sort of forever. I mean, maybe we go down like $1 trillion off of 9 trillion. Maybe we could go down too. I don't know. But basically at a very, very high permanent level. And what that's going to do is sort of put in place this permanent cushion for the financial market. So when there are crises, whether they be a war, whether they be a pandemic, whether they be a meteor, whatever they might be, I'm sorry, I say that in the book. I don't want that to happen. I just, yeah, I mean, just something, a major, any kind of major financial or natural or geopolitical event that warrants it. They would go back to this sort of moving up money from the fabrication money. Now, in terms of money supply and money inflation, really quick, because this came up a lot when I was talking about collusion. The question was, if central banks are creating all this money, back then it was like half the amount that it is, now. Won't that create inflation? Yeah, and I got this question all the time. I probably got it here. I don't remember, but we didn't have we had monetary inflation in that we had inflation of the books of central banks by more than they had historically ever been at that point in the US and collectively. We also had asset inflation. We did have an accelerated housing market in terms of prices relative to average and median wages. We did have an accelerated stock market appreciation relative to the growth in the real economy. We did have and still have an excessive amount of government and corporate debt in the world. So that was inflated. So all of those things, there was financial inflation. And yet, when it came to the pandemic, and again, I'm not saying we didn't need some extra money to help with some of the fiscal challenges that there were, but I'm talking about magnitudes of going way, way, way beyond that, back into the markets. That appreciation, that acceleration came back. And so that's why I think it's permanent. I think that decision to be able to really not think about what might happen tomorrow, what the ramifications might be, and just to basically inject adrenaline into markets through the financial system, buy bonds, do everything that entailed, showed the financial system and also governments together, not one or the other, but together, that these central banks, and it was not their original mission to do this, could step in and basically manufacture whatever was needed. And that's why I think it's permanent.
Let me just, I'm sorry to push, but what if we, as you said, we keep printing $1 trillion or $2 trillion a year? Doesn't it eventually, I'm not giving you a timeline, doesn't it eventually create inflation? 5 years, 10 years of doing this $1 trillion or $2 trillion of printing a year? I mean, how can you get away with this? It doesn't ever create inflation. I mean, it sounds like we found a gold goose to me. You could keep printing to deal with meteors and crises and so forth.
But again, I think that's what's happened. I think the inflation that we've seen, and the inflation I think we've seen, if the result of that is that it stops at the next crisis, well, then maybe. But what I'm saying is that there's no particular barrier to stopping.
Inflation, I think it comes and that causes a problem. I just don't think you can print forever without getting inflation.
Well, I think we have these moments, right? It's not necessarily a steady.
But that's not forever. I don't think we can do it for another 10 years. We've done it for 10 years.
Hopefully we're stopping now.
We've done it for 14.
We're not going to stop, and I agree.
I'm saying we're at pause now in terms of creating money, but we're not at stop.
So let me see if I can. So we got a balance sheet of what, 7? The Fed's balance sheet 8.7, and there are no foreign buyers for that, right? For that much, right? And there are no domestic buyers, so it's stuck on the balance sheet of the Fed, right? And the only way it can come off the balance sheet basically is for there to be buyers, right?
Or time.
Or what do you mean time?
Well, that's, as Alex said, there's a lot of long bonds. So I mean, they're very long bonds. So anywhere between, let's say 10 to 12 year period. If nothing new is bought, if no new crisis happens, if nothing extra.
Well, that's never happened.
I know, but that's what I'm saying. But that's the. So no.
Yeah. So the permanent distortion is that there's no way out of this without foreign or domestic buyers, and so they're trapped, right?
Yes.
In England, in London, there's a sign that says "Do not enter unless egress clear." They've gone in, and there's no clear egress without buyers, right?
Right.
So that's the permanent distortion, isn't it?
That, and then what it does to the connection between the real economy or long-term capital investment, which was technically why the stock markets exist, technically in the bond markets. It's to basically fund the economy, fund companies, fund multiple businesses, strategies, and so forth, as opposed to just themselves. So yes, I think that, and actually it's interesting on the numbers there, because when you talk about no buyers, that's actually way more. I really didn't add that in this. Well, I didn't in this way. Normally, the biggest buyers of U.S. debt are China and Japan. This has been the case over years, and normally they hold a little over $1 trillion each in their central banks, on average, right? So they have not increased in basically any magnitude, and certainly not on a proportional basis to what the Fed has done to basically buy U.S. Treasury debt. And so there are literally no buyers. Now you have pension fund, but you have other regular buyers that need long-term debt to be able to meet their liabilities. Again, this happened, there's a problem with this in the UK. It happens in the US. It happens all over. The reason, governments borrow money, issue bonds to balance their budget, support their economies, and to pay for future liabilities. It just works out that way. But if you don't have that, that's where you have the need for more printing. Effectively, you need that buyer of last. This is not a lender of last resort, I guess, it's a buyer of last resort as well.
If I could come back to a basic point of what the Fed does, is it manipulates interest rates through its buying and selling activities. And I would argue that that is the principal cause of the distortion in the markets, with filtering effects through to the bond market. My question is this: why is it necessary? Why is it desirable to have a federal agency run by a bunch of bureaucrats influencing interest rates? Why can't we in this country, in any event, rely totally upon the financial markets to set interest rates across the entire yield curve, from overnight money to 30-year money?
So just on that, I think if it was just the financial markets, we would see a situation where we'd have effectively, no cost money forever into the financial markets, which we kind of have by way of the Fed, but just sort of in overdrive. And we would have zero jurisdiction over any of that. Now, that said, I said before that we don't really have a way to either monitor or elect the Fed directly as citizens. So to an extent that's there. But I also wouldn't want to trust Jamie Dimon. I'm just adding them all together, the financial community, to set the cost of money and to do that in a way that benefits the rest of the economy versus themselves. Now I'm saying the Fed's also at blame for that as well, but I would feel less certain about Jamie Dimon, again, just as a representative doing that. Well, we've seen that the financial markets are able to be very, very knee-jerk, very uncertain, and very volatile. And so if you're a small business person, or you're someone trying to monitor your mortgage payments, or just whatever, you don't want to trust that. Now, that said, I also agree that right now the Fed's basically showing itself to have the same sorts of results with the behavior that it has. I personally think that we should be able to have more of a say, not in terms of the markets, but in terms of our representation or actual vote, at least in terms of Fed policy or Fed leaders, because right now they're not actually accountable to us. Jamie Dimon's definitely not accountable to us. And the markets have already shown themselves to leverage by too much the money that they receive. And that creates greater uncertainties, greater volatilities, and greater distortion between money that goes into the real economy versus the financial market. So I think they're quite not trustworthy either.
I have three questions. One is with regard to the so-called independence of the Fed. We say they're not accountable to us, but neither are any of the other agencies. None of them are created by the Constitution. It's really congressional dereliction. The Fed's not unique on that score whatsoever. Congress could abolish it. They could require you or a different person to be represented on the Open Market Committee rather than bank presidents. So it's the Fed's not there by spontaneous combustion. Congress
No.
delights in escaping accountability for anything, but it's not different from other ailments we have. So just one point. The second one I wanted to make is if the Fed is losing huge amounts of money, why do they report profits that they return to the Treasury every year on the budget? And there's no congressional appropriation that supports them whatsoever. You'd figure if they're losing proposition, they have to go to Congress for money, which they never do. And the third is, aren't there limits on interest rates? The United States now with over a $30 trillion national debt, the carrying cost of that $30 trillion, if interest rates go back to their average, will absorb
That's
the
wrong.
entire budget. That just can't happen. There's something has got to give.
So, yeah, I mean, I definitely agree. And this is one of the sort of mathematical conundrums as well as something that, also is an issue to the economy in terms of actually getting money out, capital into investing in the real economy. It is true that the higher and faster that the Fed raises rates and subsequently rates are raised in other places as well, it's going to create more of an expense for the budget. That's going to basically help to increase the deficit. And then you're going to need at some point when there is a crisis in the Fed's manufacturing money to come in and effectively buy that extra debt. So again, you're creating a Ponzi scheme. So that is something, but I agree, and I agree with you that it was Congress that passed the Federal Reserve Act. It was Congress that looked at the dual mandate in the 70s, or that passed the dual mandate, or calibrated the words to encompass this idea of price stability and full employment as being the dual mandate of the Fed. That was added in later, but there has not been a real accountability of the Fed by Congress. There has not been any rewrites since then. And they're not even of the budget for it. Congress actually does appropriate money for like the building, like for like the staplers and the computer systems. And there is a certain operating budget that comes from Congress. And you're right, there is also profits that go to the Treasury Department. Those profits, this is how weird the accounting is. Those profits come from the money that the Fed actually is getting right now for the assets that it has on its books, not the mark to market, not the evaluation of the bonds that it has on its book versus how it is financing there, the 1 point excess trillion that Alex was talking about. So that doesn't actually it's reported. I mean, it's obviously computable, but it's not the number that represents the amount of money that goes back to the Treasury Department. So arguably, there's extra money going to the Treasury Department that is making the ultimate loss of the Federal Reserve's book bigger, but it's coming out now. And the ultimate loss relates to that difference between funding at cheap rates, having those rates go up, having the value of their treasuries and mortgages go down, and the difference between that whole mess, which is the over 1 point something trillion. So it's like what Wall Street, well, it's like what companies do when they say, okay, well, all of the profits for the next 20 years, we're just going to realize right now and say we have a profit. It's not exactly like that, but it's a Fed basically saying right now we do have money coming in. We do have payments on those treasuries coming in that we're holding. It's just that they don't really match up to ultimately the loss that we're creating by raising rates and keeping these bonds, which are depreciating in value on our books. So it's timing. And that is something that Congress should be able to want more information and transparency on. And this is an issue. I think Congress is so confused. Congress isn't really open to paying attention to the negatives of this sort of accounting mismanagement of the Fed and how that's one of the things that creates instability. Congress believes that the Fed raising rates is actually lowering the cost of gas in some weird way. Audit the Fed, yeah. He issued it. I was on a Bernie Sanders committee to look at auditing the Fed, and the transparency of the Fed was back in 2011. And from both sides of the and just nothing. I mean, it's just crickets on that.
I think to some extent we're looking at the wrong things. As an analogy, a drug addict that wants to avoid the pain of withdrawal keeps taking drugs, And he keeps taking them as long as he wants to avoid that unpleasantness until he kills himself. To solve his problem, he has to go through the pain of withdrawal. Okay. I think there's an analogy there. I think it's important in looking at this to clearly distinguish the role of the central bank from the role of the financial sector and from the role of government, which spends money. The Federal Reserve doesn't give money to anybody, temporarily lending collateralized loans to banks, but that's nothing. They buy things, they buy government debt and government guaranteed debt, and the money that they create in doing that goes to the people who sold them that debt. So they're very unlike the government, which has welfare programs and builds highways and unfortunately funds armies and stuff of that sort. I think I would characterize the main problems in two simplistic ways. One, the government itself, in deciding what it wants to spend, has lost much discipline for having to pay attention to the willingness of people to pay for it. The financial system has lost some of the attention it needs to pay to the risks it takes to keep them reasonable, because there's somebody there, the central bank, who steps in and bails them out. There's a loss of discipline between these, because the central bank will buy up the government debt, it will buy up failing bank assets, and so on. So the system has lost the kind of discipline it needs between the two. So let's come to the central bank. The gold standard, and I'm not advocating that we go back to the gold standard, but I'd like to go back to something that's an awful lot like that, imposed a very clear rule. It wasn't followed diligently, but it was nonetheless a very clear rule for how the central bank was to expand the money supply. Wasn't supposed to expand it more than it had gold to back it, or, I don't want to go into the details of the gold standard. I'm a big currency board fan, which is a market-driven money supply thing. And Bert's comment about interest rates, the Fed doesn't set interest rates. Interest rates are the other side of money. It's the other side of the coin of money. So when the Fed raises or lowers interest rates, the counterpart is money grows faster or slower. I always look at it the other way around, that if they increase money more rapidly, they tend, until the inflationary premium gets built in, they tend to push interest rates down, et cetera. If what we need to do for the central bank, we need to restore discipline in all these areas, but for the central bank, we have what's called inflation forecast targeting. Congress mandates now a 2% inflation rule. The Federal Reserve is then free to try and deliver on that, and they're held accountable to that. And they've done a reasonably good job up until quite recently. So that regime is really complicated, because what they do today does not affect inflation for another year to 2 years. So you can't say, what they do now has to give us the inflation we want right now. There's a long lag. They have to forecast. Very complicated system. And I think they've largely done a reasonably good job until the last few years. And they were pushed into really bad behavior by the government. All of its excessive spending and debt finance, et cetera. So to reestablish discipline in that whole thing, I would like to see the central bank put back on the kind of what I call a hard anchor, which gold was. I would not choose gold, but I would give them a hard anchor by which they just passively buy and sell to the market or whatever the market wants at that official price for that hard anchor. That's called a currency board system. And there are central banks that have that. That would completely remove monetary policy. There would be no monetary policy. Money supply, which is the essence of what the central bank is all about, is, controlling the money supply. It's not funding people's retirements or other things. It's controlling the money supply to keep the value of money as constant as possible, at 2%. That's their contribution to the economy. And they need more discipline. They need a different system to discipline how they do that. That's the solution.
So I agree without any sort of mooring, whether that is a cap, whether that is a ratio, whether that is a hard asset, whether there is a basket of currencies plus a hard asset, whatever it is, that having had the event of the gold standard being removed as that anchor in 1971, that created a situation, it didn't happen then, whereby the Fed and other central banks had to basically moor themselves less so to anything or any sort of calculation or any sort of physical underlying asset. And I think that's a problem. And I talk about that in collusion with the SDR and whether or not, potentially that could be a currency basket with some form of gold as well. Of course, then we have to realize that gold is also measured relative to the dollar. Gold is measured relative to other currencies. And this is a whole other, obviously a conversation, but there's other levels of currency relative to gold that would have to be taken, whether it was gold or something else. But the idea of figuring out a way to have some sort of a limit so that when there is a crisis, and that's not what we've seen in the last two major crises, financial crisis and pandemic crisis, this hasn't happened, but that there is some restraint that's imposed on the central bank system itself so that you don't have to deal with what happens in a non-restrained environment, which is what we're seeing now, which is that the money doesn't go into the real economy. It doesn't act as one-to-one relative to even government deficit proportions or to what the government needed in a crisis. It goes way, way well beyond that. And as a result, the excess goes into the financial system just by the fact of how it's structured, and also gets leveraged into that financial system. And it sort of goes therefore into a space that is disconnected from being in the real economy in a more permanent strategic way, where the government could also, separate thing perhaps, but also have more discipline in terms of when it does borrow money to connect that money to strategic growth of the economy. I mean, the fact that we just came up with an infrastructure act last year. But basically, and I still question where any of that, even the seed money, it's over a 10-year period, okay, but like where any of that's going, so I would like to see on both sides, here's money that's being appropriated for long-term, I'll just call it infrastructure, but it could be any form of long-term capital intensive economy growing, productive forms of future growth. And on the other hand, money that's being created, some of which possibly to go to that process, but we don't know because it's not just discipline. We just don't know. There's no report back to us. I'd like to see that, but also the fact that there's all this excess money that's being created by central banks because they don't have any kind of a limitation. And so it's basically an opinion at the time. And I think that's why we do currently have this permanent distortion between how money can be created, how it is created, and where it goes versus where it doesn't go.
I'd like to get your thoughts on what you actually think the inflation rate will be from 23 to 25, because that will actually clarify in my own mind, your thinking process. And one of the things I wanted to mention is that we've seen what's happened in Britain. So in Britain, they were raising rates, and then they had this crisis, and then all of a sudden they had to start printing money again. So you could see the same scenario happening in the United States. There could be a repo market problem. There could be some problem in Turkey. There could be some problem in the Chinese banking system, which means that, right now they're trying to raise rates, but at the end of the day, they may have to start printing money again to avoid a crisis. So as a result, you could easily see a scenario where the inflation rate ends up being 10, 15%, 20% because of a crisis out there. So I guess I would like to see your thoughts right now, based on the data that you have now. Where do you actually think interest rates will be in the next, 2 to 3 years?
Well, in terms of short-term rates, right, we're already in the sort of mid-3 path, right? So I do think we can get to a mid-4 path. I mean, I think that's ultimately what I believe will happen, is that within the next year, what I believe will happen is that the Fed's going to raise 75 next week in this current process, but that because, not just because, I mean, and I see what you're saying, there is to an extent some monetary policy tightening that will take a long time to get through the economy, even if you didn't have supply chain disruptions or geopolitics or issues with fuel or anything else. But I think it's still on this path right now where it's using rates as its main, obviously, tool of monetary tightening, as are other central banks. I think inflation is going to still stay high for a number of years. I don't know if it's going to stay past 8 point, where it is now in the 8s. I think, depending on if we do have more economic slowdowns on the back of that, we could see a 6 to 7% rate, but I just don't think we get back to 2% in the next few years because of why we are where we are. So I see that continuing. And so I do see the Fed continuing to raise rates, but more slowly in terms of the magnitude into next year. Then I see them taking a moment, not necessarily because it's in their plans, but because I believe there'll be economic slowdown as well as higher inflation of a lot of these prices at the same time as a result of where we are, and also rates being raised so high so quickly. And then I think ultimately we get to a year or two down the road, and I think they're going to potentially start easing. But in the meantime, because of some form of economic deterioration or tightening of the financial market, whether that is in the repo market, whether that's the credit market, whether that's through defaults, whether that's through foreclosures, whether that's through delinquencies, or any of the other things that banks are starting to put more reserves on their own books aside for. So I see that all in the next couple of years. But like in the UK, there can be a situation where the size of the Fed's book stays relatively stable, where they are letting bonds perhaps roll off, but they're also buying sort of little bits of bonds in between when and if that's needed from a liquidity standpoint for the banking system, which it is. And so I see the size of their book staying relatively high. I mean, I see it with an 8 handle for the next couple of years along all of this. In the UK, well, because it's necessary, right? I mean that's actually permanent distortion. How could, when we were quantitatively tightening, the Fed the books in 2019, there were a lot of crises going on, and the economy was slowing down in 2019, depending on what data you looked at. Some people said it wasn't, some it was. But what caused the Fed to put more bonds on their books was the banking system, was the tightening of the repo market, was the lack of overnight trust or financial viability between the big players. That's why the Fed started increasing very quietly, and they did not call it QE. I did. Some people did. They did not. They increased their book by 10%, right, from 3.7 up to a little bit more, 4.1, in a few months. So can the book also rise? I mean, 9's a really big number. They never got past 9 trillion. It was just a bit under. And it's a really big number, but I mean, so at the time was a 4 handle. And again, at the time in 2007, 2008, the US debt, the size of all US debt was 9 trillion, public debt was $9 trillion. Now it's $31 trillion, right? So if we continue to see elasticity of debt, for multiple reasons, the lack of buyers, the problems that can come when there are real liquidity crises, and we can talk for another few hours about how they're caused by some of what Wall Street is still doing right now and will be. There is a potential to grow past that also. I mean, again, that's why I think this is where we're at. I mean, this is a, unless there's some external form of anchor or cap or ratio or something imposed upon the Fed or other central banks when a crisis is deemed warranted, to get a reaction of, printing money, of creating a QE policy or something more covert, I think it's going to happen.
So all of the crises aside, all the monetary policy, all of the juggling, all of the mistakes that the government's made, big banks have made, the Fed has made, 300 plus million Americans have a question. They want to know, when is the pain going to end? By October 2021, their real wages were down 1.6%. From 2021 to October 2022, it was down another 3%. Meanwhile, inflation as of October 2021 was up 6+%. And then from October 21 to 22 was up 8+%. So we're looking at 20% of pain compounded for Americans. So they don't care about the debt. They don't care about what the Fed's problems are, the government's problems are. They want to know, when is inflation going to end and their paychecks at least stop bleeding? What's it going to take? My prescription is recession. Bite the bullet, have the recession. That will get rid of inflation, and the markets will come back. The things will heal themselves. The more they try to postpone it, the deeper the pain is going to get.
Well, I think in terms of we are seeing a recession in parts of the economy, and obviously we continue to see inflation for specific reasons, like in rents, because of where the housing market got to throughout this entire period, and more so in the post-pandemic period. So whether or not wages can peach us.
Housing back in 2008, and
Well,
healed itself with a recession. Housing prices went back down, and the young people that couldn't buy houses for a 3 or 4 year period, all of a sudden had 10 years of prosperity. They could buy houses.
And during that time, absolutely. And then we sort of started creeping up, and then we sort of jumped up. And during that time, for the most part, until at least 2015, rates stayed pretty much at zero. So there was a sort of push through the banking system to continue with some more aggressive regulations on lending, but to continue to lend less to real people and to smaller companies and larger ones, but nonetheless to do so. And so that allowed there to be sort of a keeping up. It wasn't wages were creeping up relative to low inflation at the time. They were still lagging what was inflation at that time in terms of housing prices, but money was still cheaper. I'm not advocating that money stays cheaper.
People seem to be satisfied to say that and expect inflation to continue to rise. This is a compounding thing. They're at 20% now, which is a big problem for American
It is. It absolutely is.
There's never been such a transfer of wealth that this country's ever seen, except everybody's silent on it.
So
40% over a 2-year period, that wealth is transferred from the middle class, the average, taxpayer, to the upper class, the people that are collecting at the top. And the prescription is, just bear it for another 2 or 3 or 4 years until inflation comes down. By then, it's going to be 40 or 50%.
Well,
Is that going to leave the middle class for the future?
Unfortunately, the middle class and the lower portion of society in terms of income has been hurt along this entire path. I mean, the inequality, the lagging behind all of that is not new. It's just been exacerbated. But one thing I will say, and this is important, this is actually by a study from EPI, Economic Policy Institute, which I'm sure many of you are familiar with. They're right here in DC. They put out an excellent set of research. I said these are numbers, but they're really important to note is that corporate profits, the increase in profitability as it relates to price increase, so inflation in the things we buy, in the things we consume, have gone up substantially in the last 2 years relative to the appreciation, the rise of wages that corporations pay. From 1979 to 2019, wages were effectively almost 62% related to the increase in the cost of various goods. So there was profit, there was stuff, there was stock, but wages were a part of those profits. In the last 2 years, wages have gone down to 6.9% of the profits. So some of the inflation that we are seeing today, and there's other ways to deal with this. Some of the inflation we're actually seeing today and things that people actually need and items and food and some fuel costs, not all of it, some of it's supply driven as well. But collectively, it isn't related to wages. So how do you fix that? I don't think it's to take more pain. I think what's happening right now, if you just look at the math, is that people's paychecks are simply not stretching to inflation. And yes, you can bring down in various ways inflation, but it's going to take a while, or inflation can come down because the economy is slowing down, or recession is coming, and that's going to have a price reduction. But there are items that people actually need. And one of the reasons that inflation is remaining high right now is because the relative gap between people's real wages and inflated prices continues to actually grow. And the profits that are coming out of why those prices are inflated are continuing to be more of a portion of the price inflation than wages are. So the whole thing is getting worse. So if I'm having to pay high rent, and if I'm having to pay higher fuel, and I'm having to pay higher food off of the same wage, I still may buy stuff that I need. And I still may be participating in the upside part of that inflation because I have no choice. And at some point, yes, I'm going to buy less and I'm going to make choices. And a lot of things are going to happen, particularly at the lower levels of the economy with lower wages. But we should be really clear on the fact that right now, the phenomenon of inflation has another dark side. And that is that when the Fed, I just go back, when the Fed talks about cooling off the labor market, and sort of pushing wages down, it's completely the antithesis of what's needed for people to basically be able to afford their expenses.
So you got 2 minutes.
Yeah, thank you.
Make it short. We got 1.5 minutes.
Do I have the mic? Okay. I want to throw out something to you. Thank you for being here. Is someone else talking? Okay. In the mid-80s, we moved from stakeholder to shareholder capitalism, where the CEOs and the people felt their only responsibility was to enrich their shareholders. Then we saw other countries put in policies to make it easier to offshore our jobs and increase shareholder value. But it did major damage to the industrial and technological base of the country and millions of jobs for our workers. Probably since China joined the WTO, we've run about $8 trillion worth of trade deficits with China. Last year, and I don't think most people understand this, our trade deficit in manufactured goods was $1 trillion. Now, as we put interest rates up in this country, the dollar is being driven up in value, which will probably feed the trade deficit for next year, make it bigger. So what is the impact? Now, and Bruce was telling us, we got a $31 trillion budget deficit.
Yeah.
If you're offshoring your real economy, and if these interest rates are going to make our real economy, people produce goods have less of a role, won't that drive up our budget deficits? And as interest rates go up, the cost of financing the budget deficits is going to increase dramatically. Where are we headed in this country? I mean, I think we got to talk. What does this mean for the real economy and for the geopolitical position of the United States?
Well, again, yes, higher rates, this accelerated, a combination of the uncertainty post-COVID and the accelerated rate increases kind of happening one after the other has created a situation where the dollar has been really, really strong relative to other currencies. And it's one of the reasons, for example, the UN and the IMF are coming out and saying, well, this is really hurting the external countries, but how it also hurts us is they're able to effectively buy less of what we do produce. And plus, we do need to be producing more here anyway, and the cost of doing that gets higher as rates go higher. So these are other factors of looking at what part of the real economy we actually grow here, what we're committed to, how we're committed to, again, workers here, and that's going to cost more money to have jobs stay here, and how we finance that. And yes, it's true that as rates go higher, more quickly, the dollar stays high. Again, that does weaken the position that we have relative to other countries buying what we have, buying our debt, et cetera, because they can't afford it, as well as instabilities that they have because they borrowed from us, and they have liabilities in dollars to pay us back with, and their economies are also now slowing down because of other reasons, because of inflation, energy crises, and everything else throughout. So, I mean, it's a problem for us when other countries can't pay on their debts in dollars. And it's also a problem in terms of financing ourselves to grow our own economy and to pay our own workers here, which I think is also necessary.
Thank you.
Thank you.
We've run out of time. I'm sorry. I have to shut this off at 8:30 but please come up and ask Naomi. She's got time to answer more questions. Thank you so much, Naomi. Great job. Very good.